Hello everyone. Today I will be discussing a very important and practical decision of the Honorable Income Tax Appellate Tribunal Bangalore bench in the case of Instakart Services Pvt Limited, which is a Flipkart Group company. This judgment is significant because it reaffirms the real income doctrine and clearly lays down where the revenue must stop questioning business strategy and commercial wisdom. Now, let's understand the facts of the case. Instakart Services Pvt Limited is engaged in providing logistics and delivery services, which includes pickup, last mile delivery, cash on delivery, and reverse logistics, primarily to Flipkart and also to third-party customers. Now, 3 assessment years are involved in this case. For assessment year 16-17 to 18-19, which were the initial years of operations, Instakart incurred substantial business losses, which is exceeding 770 crores Indian rupees in the initial years, which is assessment year 16-17 alone. These losses were fully recorded in audited books of account and also supported by vouchers and agreements, and this was never disputed by the learned assessing officer in terms of genuineness of expenditure. But in spite of that, the learned assessing officer disallowed the entire business losses. So these are the facts. What is an issue which is involved with the core issue which is before the Honorable Tribunal was, can the revenue disallow genuine business losses merely because it believes that the assessee's business model lacks profit motive? More specifically, can the tax department rewrite commercial contracts, or can it tax notional or hypothetical income which was never earned? Or can losses be disallowed without rejecting books under section 145 subsection 3 of the Income Tax Act? Now let's see what was the revenue's argument in this matter. So revenue alleged that Instakart was charging Flipkart, a group entity, lower rates while paying higher rates to third-party vendors like Blue Dart, and showing an absence of profit motive and deliberate loss-making arrangement. On this basis, the learned assessing officer as well as the learned CIT appeal concluded that the losses were not genuine business losses. Now, let's see what was an assessee's argument before the Honorable Tribunal. The assessees argued that rates charged to Flipkart and third-party customers were identical in the relevant years. Losses were common in capital intensive and competitive sectors like e-commerce logistics. No defects was found in books, and section 145 subsection 3 was never invoked by the learned assessing officer. Revenue was attempting to tax income that never accrued. Reliance was placed by the assessee on a settled Honorable Supreme Court jurisprudence and earlier Hon'ble ITAT rulings in Flipkart India own case. These were the argument by revenue as well as by assessee. Now let's see what's the Honorable Tribunal rulings and the findings in this matter. The Hon'ble ITAT decisively ruled in favor of the assessee and held only real income can be taxed, not hypothetical income or profit the revenue assumed should have been earned. The tax authorities can not step into the shoes of the businessmen or judge commercial expediency. Audit books result cannot be disregarded unless specific defects are found and section 145 subsection 3 is invoked. And losses in initial years, especially in new age and high investment business, are a commercial reality. The Honorable Tribunal relied heavily on its earlier landmark decision in Flipkart India Pvt Limited, reiterating that profit foregone is not expenditure incurred and hypothetical income cannot be brought to tax. Now, what was the final conclusion or the key takeaway out of this judgment which we all get and which helps us in our regular matters, which we can use in our regular matter, the ratio? The Honorable ITAT allowed the entire business losses for all 3 assessment years and set aside the orders of the learned assessing officer and the learned CIT appeal. The key takeaway which is very, very clear coming from this judgment is the Income Tax Act taxes income, not business imagination. Commercial strategy, pricing decision, and long-term market positioning remain the prerogative of the entrepreneur, not the tax officer. This judgment offers a strong protection to startups, e-commerce players, and group entities facing aggressive scrutiny on business losses. Thank you so much. Thank you.